Last year, the Federal Reserve announced clarifications to Regulation II. As a July 2023 deadline approaches, what does that mean for the industry? Hi, this is James Hunt, and this is the Feedzai Financial Crime News Weekly Update. Regulation II is also referred to as Reg II and the Durbin Amendment, and it was introduced back in 2011 because there was concern that merchants and consumers were having to foot the bill for extravagant processing fees for domestic US debit card transactions. Prior to the Durbin Amendment, the merchants didn't have a choice around which debit network they could use. So the point of the Durbin Amendment was really to allow merchants to have a choice to be able to route debit card transactions through a more cost-effective network. That also means that the fees that card issuers receive, so the interchange fees, have subsequently dropped. Now, these fees were typically used to offset the costs of the technology stack to be able to help process those transactions, but also for additional services such as security and fraud prevention. There was a clarification raised against the Durbin Amendment to state that card not present transactions should fall into scope and that issuers have until July 2023 to comply. Credit unions have been very vocal on this, so much so that the National Association of Federally-Insured Credit Unions actually asked for the clarification to be withdrawn. They were concerned about the negative impacts it would have specifically on credit unions. Firstly, smaller debit networks don't necessarily charge the fees that some of the more traditional, or maybe the signature networks of Visa and MasterCard charge today. This means that potentially the credit unions have to perform greater security checks or fraud prevention checks because some of the smaller debit networks don't necessarily have the same levels of fraud protection available. So not only are credit unions or card issuers receiving lower fees for processing card transactions for their customers, but they potentially have to spend more money on fraud prevention tools. One of the clauses is that a card issuer needs to give a merchant a minimum of 2 unaffiliated networks in which to process their debit card transactions. Signature networks would be the likes of Visa, MasterCard, and Discover, and the main rails today. Now, the reality is that all three of those players also own some of the local debit card networks as well. So a great example is that Visa also own Interlink. So an issuer can't offer a merchant the ability to process on the Visa signature rails and also the Interlink rails. It has to be a completely unaffiliated network. So the benefits of Reg II is really for regional, local, smaller debit networks to actually start to offer value-added services and additional fraud prevention services to give greater insights to card issuers. Not only that, but it's also a really good opportunity for card issuers themselves to look at their current systems and decide whether or not existing systems can be enhanced by utilizing more machine learning, AI technology to remove a large number of the manual processes that they may have today as part of their risk strategies. So with the pending deadline of the clarification regarding Regulation II, there's speculation in the market that we could soon see a move that covers credit cards too. Why don't you drop us a note in the comments with your thoughts and or concerns? Thanks for watching, and that was your Feedzai Weekly Update.